All right, good morning, everybody. I want to, on behalf of GAMCO and Gabelli Funds, I want to welcome you to today's symposium. My name is Chris Marangi. I am a Co-CIO for Value at our firm, along with Kevin Dreyer, who's here, and Mario Gabelli, who established our firm in 1977. I have the distinct pleasure of introducing my teammate and fellow portfolio manager and the architect and general contractor for today's event. That's Mac Sykes. Mac joined our firm in 2008 as an analyst covering the financial services area. In fact, he was ranked #1 by the Wall Street Journal for his coverage of investment services in 2010. He is an oft-cited and oft-quoted authority on Berkshire Hathaway. In fact, leads our annual pilgrimage to Omaha each year. Germane to this event, he is one of the portfolio managers on one of our 5 ETFs, the Gabelli Financial Services Opportunities ETF. More interesting, that ETF is up over 30% this year. So when we're done here, go buy GABF. So with that, I'll turn it over to Mac.
Great, thank you, Chris. Kevin Dreyer is also here today. These are both leaders of our institution, and as you know, we'll have a little break between panels and a brief session afterwards when we finish. So please feel free to grab those guys and talk about stocks and our organization. Thank you for joining us, and for all of those on Zoom, we're very excited to have you here today. Again, my name is Mac Sykes, and we're going to be talking about a bunch of topics today, but all related to kind of the central theme around the industry, mutual funds, and ETFs. And just going back up to 30,000 feet for a second, I just want to thank my teammates, also our founder, Mario Gabelli, for helping sponsor this. The firm has a long history of doing these intellectual sharing events, bringing people together, industry experts, et cetera, to talk about relevant topics. This is our second one that we've done here. We did the last one in 2019. We have a couple of returning panelists and some new ones today. So it's very exciting, and we're in the holiday spirit as well. So it's going to be a great day. So going back, thinking about the industry a little bit, the first ETF was issued in 1993, and we've had a history of innovation. But we're seeing some material change, as we know, over this time. Today, mutual funds still dominate the landscape in terms of the investment product. ETFs are at $8.1 trillion. We'll be talking about that a little bit more today. But the real story here is the flow trends. And we know this has been going on for at least a decade, and you can see it's pretty significant. So the appetite for ETFs continues, the growth of those assets, and obviously at the expense of traditionally active mutual funds. And so this is a trend that's likely to continue, and we're going to examine some of those issues today. The first ETF was the Spider, we're all familiar with, which launched essentially at zero. It's now up to $634 billion of assets, which is pretty incredible in terms of the size and the growth and the demand for that product. And then obviously comment on the American tailwind as well in terms of the foundation of American companies going into that. So we're here today to talk about Section 852b6, and I don't know what actually 852b6 is other than the reference and some very important legal tenor around the idea of an exemption from gain recognition for in-kind distributions, and that will play into a lot of the topics we talk about today in terms of some of the advantages between ETFs, mutual funds, what's going on with taxes, is this fair, and how it weighs into the whole industry trends that we're seeing today. So our first panelist we'll bring up, we'll talk about the trend of converting some of the products, mutual funds, into SMAs, into ETFs. He did the first one, so as an industry leader, and we'll be able to talk about this, and then at the end we'll take some questions from the audience. Please welcome Robert Elwood. So a quick intro on Bob. A client once described Bob as a lawyer who thinks like a venture capitalist. As a business lawyer with tax savvy, he regularly advises companies on tax planning, and he has handled hundreds of reorganizations. Bob received a Philadelphia Best of the Bar Award in 2021 for his groundbreaking work in his first conversion of a mutual fund into an ETF. He has appeared on NASDAQ's Trade Talks and has been quoted in the U.S. News and World Report and other leading publications. He earned a BA from Haverford College and a JD from Boston University. So again, please welcome Bob. All right, so we're going to get right into it. I know you've been a pro at this for a long time. Why are so many people converting to mutual funds today, private funds, separately managed accounts? You know, we've seen an acceleration here, but what is the real impetus for doing all this?
Well, thanks, Mac. There are some tax and non-tax reasons. The tax reasons, I'm guessing probably everybody in this room has some idea about, but generally speaking, ETFs tend to be more tax efficient than traditional mutual funds or SMA accounts or private funds. And we'll be talking about that both throughout our presentation and the rest of today's program. The non-tax reasons have to do with things like liquidity and visibility and the opportunity to be a little bit more nimble. To take the example, for example, of a traditional mutual fund, if you want to get out, let's say it's 10 a.m., you can place an order, but then it gets filled essentially at 4 p.m. And in the meantime, you're exposed to the market for 6 hours, and it could be to your advantage, it could be to your disadvantage. In contrast with an ETF, you can press a button and 1 second later you've sold or bought the ETF that you'd like. People like that. They like the ability to do things like stop limit orders or other kind of things like that. So that's why people have tended to be switching to the ETF model.
Okay, and we know Fidelity's made some transfers to DWS. I'm a big mutual fund company, and I'm thinking about it. What's involved with converting a traditional mutual fund into an active ETF?
So again, I'm going to sort of focus on tax and non-tax issues. I was fortunate enough to do the very first mutual fund to ETF conversion. It was for a company called Guinness Atkinson. And my former partner, Alex Aberstadt, was really the sort of genius behind this. And it took a long time, mostly dealing with the SEC to make sure that everything was above board and appropriate, but some interactions with the IRS and dealing with the tax authorities. Now it's actually, frankly, pretty easy. From a tax perspective, we think of these as shell reorganizations. They're typically called so-called F reorganizations for a Section 368A1F. Occasionally, they might be so-called C reorganizations, but it probably ends up being about the same thing. The tax analysis on those has turned out to be pretty simple, and it's pretty much analogous to a mutual fund reorganization. The challenge, though, has to do with some of the securities law and the logistics. You typically need an N14, you typically need shareholder approval, you need to do a variety of formal steps. But you also need to do an awful lot of what I'll call herding of cats. Every mutual fund shareholder out there needs to actually establish, if they don't already have one, a brokerage account, because you can hold a mutual fund share directly. So, for example, if Mac were a shareholder in the ABC mutual fund and did not have a brokerage account associated with it, we need to make sure that once Mac ends up with his ETF shares, that they're going to be held through a broker so that he can actually trade them on the exchange. Presumably, you can understand doing that with respect to 95% of the mutual fund shareholder is easy as can be. It's chasing after the last 5% that tends to be a big pain in the neck.
So the firms like Fidelity, for instance, that have converted, they have big call centers, big support staff, but there are also fund companies that, you know, they're essentially the advisor and they distribute through bigger platforms. In terms of what is open to those that want to convert at the smaller end, but don't have that big kind of call center support and needing to convert? Are there services they can use to be able to support the conversion in talking about, you know, the direct-to-consumer custodial accounts to brokerage accounts?
I love this question because actually when we did it with Guinness Atkinson, it was the key officers who ended up making these calls. And you can imagine these are people that, you know, have better things to do than to call, let's say, a $10,000 shareholder to say, please, will you set up a brokerage account on my behalf? So sometimes we see it as basic as the DIY model, but there are various other parties that will help you with getting these approvals. You know, they're often sort of solicitation related shops, but that's the idea of how you might go about getting that done if you're not a behemoth like the Vanguards of the world.
And so going back to the legal side, what are some of the documents you need to perform the
So
You mentioned some of them, but
yeah, these have become pretty standardized now. You need a plan of reorganization. The plan of reorganization is going to look a lot like any other mutual fund reorganization. And it's got a little bit more bells and whistles because it's going from mutual fund format to the ETF format, but the documentation has been fairly standardized. You will also generally need an N14 because you will need shareholder approval. This is not one of those things where you can just sort of get by with a wink and a nod and effectuate the transaction without getting shareholder approval, because it's an organic change. You're going from one type of investment company to a different type of investment company. You need a tax opinion. That's where I come in. And there's tax rep letters. There's a variety of other kind of things like that. But it's, fairly standardized documentation. And at the moment, I think of it as being a pretty easy thing to get through SEC approval, and you get to a good tax result.
So in terms of the tax representation, is there any challenges? A plain vanilla mutual fund invests in large cap growth stocks seems probably fairly simple, but there's some mutual funds that have more exotic exchange traded vehicles in there. Well, what are some of the dynamics in terms of the tax changes and what you need to do to be able to prepare the fund to move and take advantage of the?
So I've been focusing mostly on just converting one existing mutual fund into essentially a shell of an ETF. That's the easiest way to do it. But occasionally have, for example, a mutual fund going into an existing ETF or other kind of things like that. You need to worry about things like the so-called continuity of business enterprise test, which says we want to make sure that the successor fund carries on the business of the target fund. So that's one of the considerations that comes up. And then there's a variety of other things. Generally speaking, in a shell reorganization, if it's even the most esoteric strategy, you don't have that many things to worry, because you're going essentially from an esoteric strategy embodied in a mutual fund to an esoteric strategy embodied in an ETF. There are a few traps for the unwary. There's certain types of instruments that have an automatic mark to market. And if you have a situation where it might be a C reorganization rather than an F reorganization, you may have some gain recognition on account of those types of things. There tends to be sort of derivatives and other more esoteric type investments. But those are the kind of things you want to make sure that you don't somehow foot fault and end up with taxable gain that you weren't expecting.
Okay. One of the questions is the diversification test. How does one apply that in terms of the movement?
So we've sort of jumped ahead to what's going to happen with respect to when you're converting a private fund or an SMA or a group of SMAs into an ETF. And so we've gone from the world of reorganizations, which are governed by 368, to the world of capital contributions, which are governed by Section 351. There are two key requirements. One is that each transferor needs to have a diversified pool of assets. The whole idea here is that you don't want to allow people to put in, let's say, one position and suddenly end up, let's say, for example, it's an S&P 500 fund, to suddenly have indirect exposure to 500 positions. So the diversification test says for each transferor, the biggest position needs to be less than 25% of the total portfolio, and the top 5 positions combined need to be less than 50% of the portfolio. We'll be talking in a moment about some of the challenges with applying that. The other requirement in Section 351, which generally speaking is pretty easy to satisfy, is the transferor group. So let's say it was me and Mac and Ray and somebody else. The group as a whole needs to own 80% plus of the vote and value of the ETF. You can probably imagine that that probably, as a practical matter, means it's got to be a new ETF. If you had an existing ETF with, let's say, only $200 million in it, you'd need $1 billion or so of new assets coming in a 351 to end up satisfying that 80% test. But going back to your original question, the diversification test is a little bit tricky in the sense that there's a variety of look-through rules. There's some special rules dealing with US government securities. And there's a little bit of a trickiness about the way you deal with cash assets. Generally speaking, cash assets are neither in the numerator or the denominator of those 25 or 50% tests. So I spend, I would say, 20% of every week dealing with tricky questions involving the diversification test, that's where the rubber hits the road in these SMA and private fund conversions.
And what are the challenges if you have an SMA and then getting to an ETF and having an important shareholder base as listed? How do you overcome that in terms of the getting a listed security with enough shareholders as opposed to coming out of just one conduit with an SMA potentially?
So there's a bunch of different ways you can handle that. One is, of course, we all know the economics. To make an ETF, at least at kind of a break even, you need to have $25 million or so, maybe you need 40, 50 million. It could be different depending on your cost structure. So of course, a lot of RIAs might have a client base of 100 million or 200 million or $1 billion. So sometimes the RIA can look to its own customers and say, listen, you've loved our US large cap strategy in the SMA world. We're going to do this in the ETF world, and we're going to do it at a slightly lower cost. And there's going to be some tax and non-tax advantages for you. So that part is nice. You can just essentially look to your own customer base. The other part of this, though, that we've seen more recently, and this is kind of a cool development is, and what we call is the ones that I just described a moment ago, non-syndicated 351s, because it's all sort of organic to that particular wealth manager or that group of people. It's sort of one degree of separation. We've been seeing a lot of so-called syndicated 351s, where a sponsor might go out to the world and, generally speaking, not going direct to investors, but going direct to other RIAs, will say, hey, we've got this really great idea. We would like to launch, let's make it a generic large cap domestic equity fund. We'd like to do this. And they explain the advantages. And let me just sort of pause for a moment to talk about the advantages. Let's say that Mac was lucky enough to be with an RIA, and I know that you follow Berkshire Hathaway. Let's say you were with an RIA that was clever enough to start investing in Berkshire Hathaway 40 years ago. Mac at this point might be a millionaire, possibly a multimillionaire on account of that wise decision. On the other hand, he's got the problem that if he is worried about what happens when Warren Buffett passes away or Berkshire Hathaway isn't quite as successful as it is, he's got an outsized position there. If Mac, following the diversification requirements, contributed his Berkshire Hathaway stock and other assets to the ETF, then all of a sudden he's got two nice diversification plays that are going to take place. One is that he might join his assets, which are heavy on Berkshire Hathaway, with my assets. And let's pretend my assets are heavy on pharma stocks. And maybe he's going to use Elaine's assets, which are heavy on financial stocks. So suddenly we've got a diversified portfolio that isn't quite so heavy on one name or one industry simply by the pooling. The other part that gets really cool, and that's the whole point of today's program, is on account of the advantages of Section 852(b)(6, it says you can use an authorized participant to use a custom basket and redeem to change the portfolio. Let's say, again, Mac contributes his Berkshire Hathaway stock, and it's a year later. And again, I don't want to wish any ill will toward anybody, but let's say both Warren Buffett and Charlie Munger are looking a little bit worse for the wear. The portfolio manager might say, we're too heavy on Berkshire Hathaway. Let's just go back to an old economy stock. Let's go to Exxon instead. Exxon has greater prospects for the next year. Instead of selling the Berkshire Hathaway in a market transaction and recognizing a ton of gain, what they can do is cause the authorized participant to make an investment in the fund. And then when the authorized participant wants to redeem those shares, you put in a disproportionately heavy allocation of Berkshire Hathaway. And then on the inbound side, you put a disproportionately heavy exposure to Exxon. And what you've ended up doing is essentially, in a tax-free manner, change the composition of the portfolio. So Mac, going back to the very beginning, began with an SMA that was very heavy on Berkshire Hathaway. He's got the advantage of pooling, so he's got a little bit greater diversification simply by pooling his assets with various other people. But on top of that, he's got the ability to change the composition of his assets, generally speaking, on a tax-free basis thereafter. So a year or two later, Mac's entire portfolio presumably is a little less heavy on Berkshire Hathaway and more diversified and, ends up in a better position in the long run.
So maybe just, it's tough to quote costs here necessarily, but maybe you could just frame it in terms of, the fixed costs of starting a mutual fund today versus taking on the fixed costs of the approach to move a mutual fund to an ETF. And granted, we'll take out the variable costs of the proxy and all that other stuff, but so how does that compare? Is one much bigger than the other, or are they fairly similar? I'm trying to understand kind of a financial payback. I'm trying to understand some financial payback in terms of the conversion and the cost that would take to do that.
So I'm thinking about this from the insular perspective of a lawyer because I am a lawyer. We quote these all the time, and a big chunk of this cost is legal spend, but there's obviously other sort of back office spends as well. From the law perspective, the cost of doing a mutual fund conversion, which is generally speaking the cost of preparing a new prospectus, doing the N14, doing the plan of reorganization, and some hand-holding of the board and various other things like that, round numbers runs around $100,000 or so. It could be a little bit less, it could be a little bit more. And the cost for doing an SMA conversion or a private fund conversion, where you've got the nice advantage of creating from the ground floor an ETF funded with a lot of assets, is roughly speaking the same. I think it ends up being slightly less because you don't have the hassle of doing an N14 and you don't have the proxy solicitation costs. But by less, I mean it's probably $10,000 or $15,000 less. It's not, hundreds of thousands of dollars less.
Okay, and in the throughput in terms of working with regulatory authorities to do all this, is there any difference or pushback at this point to the conversions? Any opinion on sort of that, or are we just still subject to the workloads that the SEC has to deal with in any case? And to the extent that this starts to proliferate, that creates more timing. I guess, is there any difference in the conversion filings and all that versus just the normal filings that need to occur in terms of this process, and which would be different in terms of considering the move?
So that's a really good question. And if we'd had this panel 6 weeks ago, I might have had a slightly different answer. What we've been doing at my organization, which is a company called law firm called Practus. A lot of us are former Deckert alums, which including myself. And so what we've been doing lately, and we think of this as an abundance of caution, we put into the prospectus, and if it's appropriate, an N14, a couple of paragraphs that talk about risks associated with the conversion process. And it's risks that I think of as remote, but let's say, for example, we messed up the reorganization for a mutual fund conversion, and all of a sudden, instead of the expectation that it was tax-free, it turns out to be taxable. That has a whole host of negative problems for the fund and for the shareholders. Similarly, if you mess up a 351, it's got negative consequences. Both remote possibilities, generally speaking, at a tax opinion level, you're going to get a will opinion that says it's 99% plus likely that you're going to get the expected things. But we put in some disclosure, which we thought of as being sort of bland, vanilla, and so forth. The SEC, fell upon it as if it was meat to a very hungry dog. Like it was that thing. We ended up having hours and hours of conversation with the SEC in a way that I think turned out to be really lovely and respectful, because they wanted to understand better what a 351 was all about. They generally understand what's going on with reorganizations because they've seen those with mutual funds over the years and so forth. And what we did was, in a just sort of lovely, collaborative, cooperative way, was walk them through what the tax analysis was, walk them through why we put the disclosure language there, and explain that though the risk was remote, it was at least in the ballpark of materiality, so we wanted them to understand that. Generally, the interactions are with the SEC. We don't tend to have much in the way of day-to-day interactions with the IRS or FINRA or any other sort of regulatory body that we might worry about. And I want to make this clear, the SEC was doing its job in a way that they wanted to understand this better so they could do theirs. I don't want to suggest anything negative at all about the SEC. They just wanted to sort of keep abreast of current developments.
Why don't we go to the audience with some questions. Front row. Yep.
So the president has nominated Paul Atkins as the new SEC chair, a fellow lawyer, former commissioner. Does he have any known views on ETF conversions, and can the SEC actually do anything to facilitate the process?
I have no knowledge about his views one way or the other. I think that the SEC has largely been pretty cooperative and collaborative. It was hard 3 years ago when we did the first one because it was novel and it took about 1.5 years of slogging through. And I don't think it kind of came from the top. I think it came from the staff wanting in an earnest way to understand what was going on. In the meantime, I'm trying to think, we've probably done 25 mutual fund to ETF conversions. And lately, they seem almost sort of cookie cutter like. They become sort of very easy and straightforward. My general sense, and this is purely a political observation, is the new regime is generally becoming more business friendly. So I expect that the SEC may continue to be business friendly toward these types of conversions, but that's purely a guess. I don't really have any inside knowledge.
According to the Financial Times, more than 30 fund families have applied, have submitted applications for the ETF share class structure. So from a tax standpoint, what are the advantages of full, fund conversions vis-a-vis the ETF share class structure if it ends up being approved by the SEC?
I always hate it when the audience is full of really smart people. So that's a really hard question. To sort of put this in context, we've got many, this was originated by Vanguard. They had a patent on it for a long time. The patent has expired, and now other people are planning to do that. The idea is that there might be a mutual fund that might have class A, B, and C being the traditional A, B, and C mutual fund classes with different fee structures. But then they have perhaps class D or class X that basically has an ETF wrapper or component to it in which things like these in-kind redemptions can take place. I think that if you have a fairly simple class structure, meaning like a mutual fund that was, let's say, a no-load fund with a single tier, it's much easier to do the full-fledged conversion. If you've got an existing mutual fund with multiple classes, I would give some long and hard thought to converting to a mutual fund that had the 3 cost classes plus an ETF class. That's actually a medium heavy lift on the securities law side. It's not that heavy a lift on the tax side, but you do need some tax assistance. But I would caution that all these observations are just sort of general observations. It depends on the particulars to figure out what's going to be right for each group of investors.
Bob, you mentioned in connection with a diversification test, looking to a look-through rule. Can you describe that and how you view it in practice?
Sure. Thanks, Ray. The look-through rule has to do with the diversification test we were talking about for Section 351 transfers. And let's say Jose, for example, was one of the transferors. And let's say Jose's portfolio had 23% Apple stock and 75% SPY. Initially, you might think to yourself, wow, that's great. The SPY, like all investment funds, and this applies to mutual funds, ETFs, private funds, you name it, you generally get to do a look through, and you might initially say to yourself, wow, 77% of his portfolio is these 500 stocks in the SPY. He's got to be well diversified, and his biggest position is at 23%. Wait a minute, not so fast. Apple, round numbers, makes up 7% of the S&P 500. And if you multiply 7% times the 75% that he's got in the SPY, combining that with his direct exposure to Apple, all of a sudden, he's got probably like 28, 29% Apple because he's got the 23% he owns directly, plus the roughly 5% he owns indirectly through the SPY. So suddenly you have a problem. With a simple situation like that, and frankly, the easiest way for a lot of people to do this is to just do the sort of rough justice way that I applied this, look to the mutual funds last holdings and make an educated guess. And if you're very close, you want to dig down really hard. But there are also automated programs that will allow you to look through every mutual fund. And so let's say, for example, Elaine's portfolio was 75 different mutual funds. You don't necessarily want to go through the work of figuring out, like, do any of those 75 have enough overlap to do it? There are programs that will allow you to do that, but those are typically proprietary, so you need to sort of figure out the fund manager. But it is a really important point. We generally think of the look-through rule as being a get-out-of-jail-free rule, but it can really trap you if you've got a problem where somebody's got a big position and it's represented indirectly through an SPY investment or something like that.
So you mentioned you've done 25 conversions, and I think we understand here implicitly about the taxable and the components of that. When you advise these fund advisors, what are some of the business risks? So when they're judging on these conversions, in terms of attrition, in terms of positioning going forward, maybe you could talk about what are you advising them in terms of understanding the risks before the conversion in terms of to clients, AUM levels, and of the 25 that you have converted, have there been any changes to sort of the fee structure on conversion to the ETF? Has there been modifications there or kind of market strategy post conversion?
So that's another good question. That's a hard question. So typically the fees on an SMA are going to be a little bit higher than the fees on an ETF. So I'll make the math super simple. Let's say you were charging 100 basis points for managing an SMA. Generally speaking, as you look at the competitive market, and let's pretend the SMA strategy was, again, classic large cap equity strategy. If you look at competing ETFs, the basis points at the ETF level are going to be a whole lot less than 100 basis points. So you want to think through as a manager whether you're losing money on this deal by virtue of going to, let's say, 65 basis points or some other different number. So that's a key consideration. Generally speaking, the price points for mutual funds and ETFs are similar enough that there isn't as much of a loss of revenue problem. But then the other part, and I find this the most intriguing part, and I do this a ton throughout a typical week, is the process of educating your clients about what the benefits are. And going back to the very beginning of our program today, the ETF world offers a lot of tax and non-tax advantages. And so what I do a lot, and what a manager might do a lot, is simply go out to the group of investors and say, hey, I have this really good idea. And though there's some of it in it for me, the manager, there's a lot of it in it for you, the investor, and it's a matter of educating them. We don't find almost any attrition once we sort of do the educational process. We occasionally find attrition because somebody can't figure out how to set up a brokerage account. But those tend to be small investors that aren't that big a deal in terms of the overall economics. But on the, I'm opting with my feet to say, hell no, I don't want to say it never happens, but it happens only very rarely. And part of that is because typically the RIA or whoever's in charge of the transaction has developed a relationship of trust. And with that trust comes the ability for the investor to say, yeah, if you think this is a good thing for me, I'm willing to go along with your recommendation.
Hi, Bob. One question. Given all the benefits of the 351 conversions you're talking about, do you think that the traditional swap funds are basically dead? Are there any benefits to them, partnership versus corporation?
Another great question. So for those who don't know, a swap fund, which is often also called an exchange fund, might be a situation. Let's say Mac has worked at Facebook and has a lot of Facebook stock, and let's say Ray has worked at Google and has a lot of Google stock, and Jose has worked at Berkshire Hathaway and has a lot of Berkshire Hathaway stock. What you would do is pull together those highly concentrated portfolios, and then you put them into a partnership or an LLC, and there's a variety of lockup considerations. Generally speaking, you have to hold it static for about 7 years. There tend to be higher costs and so forth. So coming back to your question, We actually just did one within the last year, but I think swap funds or exchange funds are fading in popularity, but there's still a place for them because let's say, for example, I'll use Mac again, that Mac's portfolio is 95% Berkshire Hathaway. He's never going to get to a stage where he's going to qualify for the 25 and 50% test, and there a swap fund is going to be an ideal opportunity. But having been on the front lines of swap funds or exchange funds, you've got an awful lot of heavy lifting to convince, let's say, for example, you want to end up with 30 stocks in your swap fund. You've got to find 30 different people with complementary positions and probably roughly the same dollar figure. So if Ray has $20 million of Google stock and Jose has $1 million of Apple stock, we've got a mismatch right there, and it tends to be challenging to just match up the various investors.
Hi, Bob. Thank you for this conversation. So if the disadvantage of converting, we have SMAs to ETF is that all clients will have the same portfolio. So I was wondering, is there a way to convert each SMA into its own ETF so that each client has the customized portfolio they want and still retain the tax advantages?
That's a great question. That comes up in my practice all the time. The question is, if you've got SMA clients that have either subtly different portfolios or perhaps radically different portfolios, how can you do it? It all, in my mind, has to do with the economics and the size of the positions. If you've got 1,000 different SMA clients and each of them has $1 million in it, you can't economically run 1,000 different ETFs with $1 million each in them. But if you're fortunate enough to have some SMA clients that might have the minimum to get an ETF economically viable, and again, the numbers I hear tend to be in the sort of $25 million to $40 million range, you could certainly do that. The other nice advantage that happens there, if you're doing what I'll call a one-off, one SMA going into an ETF, is you can use the track record. So the track, let's say, for example, this SMA account has had, 20 percentage points better than the S&P 500 over the last 3 years. Obviously, that becomes a very attractive feature that you'd like to emphasize. So if it's a single SMA, you can generally track the track record. You can use the track record. So that's a nice advantage. But again, it all depends on whether you can get enough assets into the ETF to be effective. The other thing that we've seen occasionally is, and this is a sophisticated technique, we have clients that create essentially a fund of funds arrangement so that they can have, a large cap strategy, an international strategy, and other kind of things like that. So you end up not necessarily having a bespoke ETF for each SMA, but you have a manifestation of, let's say, your top 7 strategies, and then you put all the people who are heavy on one strategy into it. Or proportionately, let's say you have a client that wants 30% exposure to US large cap equities and 20% exposure to real estate and so forth. You could end up creating a large cap equity fund and a real estate fund, and extrinsic to the fund, create essentially an asset allocation model.
I think I'm going to ask the last question. Fortunately, you can grab them afterwards because we're running short on time here. My question is twofold. 5 to 10 years from now, will we have accelerated the pace of conversions from today? Will there be a lot more adaptation than on the pace today? And secondarily, do you think there's any risk of some kind of regulatory change that would stop this incentive or process over the next decade as well?
So I'm probably the wrong person to ask as to the first one. We've done about 85 of these Section 351 conversions, almost all of which have been in the last 3 years. So there's been just a torrential amount of interest in doing these. And frankly, the pace has accelerated recently. So we've done, I can't even count. We've probably done, 12 in the last 6 months. So it's increasing. My perception, and again, your assessment of the regulatory environment is probably just as valid as mine. My sense is that the IRS at the moment is a little bit resource starved, and they don't really have the ability to take heavy duty controversial positions. There are people, for example, there are people in Congress and in the IRS who are not fond of Section 852B6. That's the whole big driver of the tax advantage of ETFs. There's some consideration. I think that would be a very hard thing for the IRS to overcome because it's in the statute. Congress, of course, could change the law and do away with that, which would be devastating to the ETF industry. I think the SEC has generally been very collaborative and cooperative with this, so I think the pace will continue there. But again, purely a guess. I don't know the inside baseball of either organization's approach or policies.
Great. Well, thank you, Bob.